Hello everyone! As we do every quarter, we're going to share with you the main insights that can be extracted from our digital top-down methodology. Our method consists of evaluating the attractiveness of European equities with regards to 4 complementary pillars of analysis. The first pillar focuses on economic growth momentum in Europe. The latter continues to deteriorate due to Ukrainian crisis, the inflation that is taking hold, and the spectacularly hawkish shift by the United States Federal Reserve. At the same time, economists have revised downwards their forecast for GDP growth in 2022 in the Eurozone to plus 2.8% compared to plus 4.2% expected at the beginning of the year. Pessimism is gaining ground among investors and economic agents, perhaps too much so. Thus, the ZEW expectations in the Eurozone indicator has reached levels close to the ones observed at the end of 2008, at the end of 2011, or in March 2020. The European equity market had risen by 20, 25 and 50% respectively in these 3 historical periods over the following 12 months. The second pillar deals with the monetary policy implemented by the ECB. The ECB remains very accommodating for the time being, but it will have to act during the summer by raising rates. The Fed has waited much less and has already raised its target rate by 150 basis points since last March. The prevailing feeling is that the central banks want to act quickly and strongly to counter inflation that has an exogenous origin and to avoid it spreading to the real economy, at the risk of causing a recession and having to lower rates again, perhaps as early as 2023. The third pillar of analysis is the valuation of the European market. The European equity market risk premium is 7.1%. This is a rather generous level compared to the historical average of 5%, especially as the analyst's earnings momentum remains bullish. A return of the risk premium to its historical average could theoretically cause the European equity markets to re-rate by around 20%. It is therefore not difficult to understand why the next quarterly Q2 releases will be particularly scrutinized by investors. Finally, the fourth pillar deals with behavioral aspect. The bullish momentum of equities has been broken insofar as all the major international indices are fluctuating below their 200-day moving averages, but the European indices remain above this secular technical support corresponding to the historical peaks of 2000 and 2007. The latter held in the first days of March, and the summer period will be a good test to evaluate the robustness of the technical configuration. Moreover, let us keep in mind that exogenous shocks such as armed conflicts have generally been followed by a good performance of the stock markets. This was the case during the Vietnam War in 1964, the Gulf War in 1991, the Afghan War in 2001, the Iraq War in 2003, and more recently during the crisis in Crimea in 2014. In conclusion, despite the obvious lack of short-term visibility, European equities could surprise in the second half of the year. The economic momentum is slowing down but not collapsing, and expected growth in Europe in 2022 is stabilizing at a high level. The central banks will certainly act strongly, but this is now anticipated. The equity risk premium remains historically attractive, particularly for the most value components, and the long-term configuration of the European equity market remains bullish as long as the secular support remains in place. In this context, the next quarterly publications will be key and could set a tone for a traditionally volatile summer period. Thank you, and see you next quarter for a new video by Shaheen Capital.